6 Rules on Hunting for Income. Rule 6. Diversification of risks. In the world of investment, every asset has its own risk-return profile. Let's take a look at how US equities and US Treasuries behaved in the last 2 decades. When the dot-com bubble burst, US stocks hit the skids, whereas the US Treasuries rose. It's obvious that the two asset classes are inversely related. If we put all our eggs in one basket, meaning to allocate all our resources to one single asset class, we'll have trouble avoiding the beta risks that are linked to a particular entity. Using a multi-asset strategy, however, could help us diversify our portfolios and enable different assets to complement one another. That's very crucial for striking a balance between risks and returns. Compared to US equities, the annualized return of US 10-year Treasuries in the last 2 decades was just 1 percentage point lower, yet they were just half as volatile. Let's assume we have 60% of our assets in US equities and 40% in US Treasuries. Such a portfolio might see a higher volatility than holding US Treasuries alone. However, its risk-adjusted return will be higher. The reason is that it can reap the benefits of both asset classes, meaning the growth potential of US stocks and the relatively low volatilities of US Treasury bonds. Can we achieve the same effect just by including bonds in our portfolios? Yes, if we care to diversify our holdings. So, in addition to traditional US bonds, consider holding US short-duration high-yield bonds as well as US and Asian high-yield bonds. That as a whole could help the portfolio yield a higher risk-adjusted return. It's important to diversify risks because financial markets are full of uncertainties. Adopting a multi-asset approach helps diversify beta risks and balance the risks and returns of different assets. That's the key to achieving stable and desirable gains in the long run. Active is hunting for income. Stay tuned for the 5 other rules on how we seek income opportunities for you. Allianz Global Investors.